This podcast is for general information only. If you're after advice for your own situation, it's best you chat with a licensed financial advisor. Welcome to the Intergenerational Thinking podcast, brought to you by Orellan Asset Management. I'm Chris DeLeva, CEO and CIO of Orellan. When we launched Orellan, one of the key things that we wanted to do was to bring the best global investment managers to our clients here in New Zealand. Now, that's a tough thing to do from New Zealand. So one of the first things we did was search the world for a partner that had a proven track record of picking top global investment managers. And that's where we came across a firm called Wilshire. Wilshire are a firm that works globally with clients from family offices to university endowment funds. And one of the key things that they've been doing for 50 years is helping their clients identify the very best global investment managers. We're really excited to have a partnership with Wilshire. And I'm even more excited that today on the podcast joining me is the Head of Manager Research, Rob Noe. Rob joins us from the Windy City, otherwise known as Chicago. Rob, welcome to the podcast.
Thanks, Chris. Good to be here.
Now, Rob, on the podcast today, I'm really keen to dig in to how you and your team identify the top global investment strategies. But before we do all that, I'm keen for the listeners to learn more about Wilshire and your role there.
Sure. We'll start with Wilshire. So Wilshire is a top 10 consultant in the U.S. We have about 1.5 trillion in assets under advisement, around 125 billion in assets under management, and approximately 300 clients. Most of our clients are based in the U.S., but we've been expanding that recently and actually very excited about our new relationship here. In terms of the different types of clients, it's a wide spectrum. So we have large clients like the California State Retirement System, down to small broker-dealers and wealth managers. And that, in turn, has us working with many different types of clients that are sophisticated or somewhat unsophisticated. So it's been a good experience for our team to work with different types of clients, different types of clients' needs, and try to match what we think are the top performing managers with our clients.
And Rob, a little bit more about you and how you got to your role at Wilshire.
So I've been with Wilshire now for 14 years in manager research the whole time. The first few years, I was just a member of the team covering global equity strategies. The past 9 years, I've been the head of the team. Before I joined Wilshire, I was with another consulting firm here in Chicago that was acquired by Aon Hewitt. And before that, I was with two public pension plans in the state of Illinois, Illinois Teachers and Illinois Municipal.
Cool. Okay, so I took from that you're relatively experienced in what you do, so you're a really good partner for us in picking our global investment managers. Now, Rob, something we've talked about a bit since we've been involved with one another, and it's been really good getting to know you and the team that's been spread around America over the past couple of months. And one of the things we've talked about is just the contrast between New Zealand and the US in terms of how investors tend to invest. And I really want to give the listeners a bit of a contrast to, how does a US investor go about building their portfolio? So take us through, say a large family office in the US with a 60-40 portfolio, 60 growth, 40 income. How's a US investor investing that portfolio? What are you building for people there?
Yeah, so think about a U.S. investor, and with the U.S. being the more dominant market in the world, we tend to be a little bit more in terms of a home country bias. And so as opposed to looking at global equity in general, most clients tend to divide up their portfolio, what is in the U.S. and then what is outside the U.S. And then within that, you will have different buckets. So private equity, private fixed income, private real assets has all been kind of an increasing proportion of these client portfolios going forward. So I would say the traditional asset classes, traditional long-only equity fixed income, have actually been a source of funds over the past several years to fund some of these private equity and private fixed income and private real asset portfolios. But thinking about a 60-40 portfolio, the predominant equity portion would be in the U.S. There would be a smaller portion non-U.S., both developed and emerging. You would have an allocation to privates kind of across the equity and fixed income segment. And then you would have traditional fixed income. But thinking about a 60-40 portfolio, you would probably have close to 20% in privates. And that has been increasing recently.
Wow, okay. So what would the listed equity component be within that portfolio? Is that roughly the balance? Is it around 40 or
Yeah, it would be the balance. It would still be the bulk of the equities would be in the public listed. But to be honest, it's been more of a source of funds over the past few years. So that private portion has been growing.
Okay, but there still is a significant global equity component, I suppose, within portfolios. But as you're saying, it's split more US equities and international equities. Now, just onto manager identification, as any good podcast host or any would-be or a try-hard podcast host, I've done my research before I've come to meet you today and looked through some other conferences you've spoken at and podcasts you've been on, and I've actually came across a quote which I want to read out to the listeners, and I'm going to read it out, but I'm going to New Zealandize it because you guys have different streets in US Monopoly. But this is what you said. So you said, when you play Monopoly, everyone wants either Park Lane or Mayfair, and a lot of other people forget about the other properties around the board. But typically you win the game by investing in those other properties that may be unloved. Now talk me through that quote, Rob, because you were talking about it in terms of manager research. So what exactly did you mean by that?
I think there's a couple ways you can look at that. The most obvious way is it's our goal to find undiscovered managers and to get into them earlier before the crowd gets in. You can typically find a good manager and have a good string of performance before everyone jumps in. An example of this would be 10, 12 years ago, we added a new sub-advisor to our Wilshire International Equity Fund, WCM. It's a manager that's pretty well known now, but 10, 12 years ago, not many people knew about it. At that time, it was probably less than $2 billion in total assets. And we had gone in and did some interviews with them, and they just sounded really different. So they talked about moats, they talked about moat trajectories, a lot about culture and kind of the touchy-feely stuff in terms of investments. And they were very different. We took a chance with them and were really interested, and we added them to our investment, our international portfolio. And it's been a home run for us. And we've seen a lot of that outperformance over the past few years. It's one of the reasons why that fund is 5-star rated by Morningstar. And again, we were able to get in early before everyone jumped in. Now the strategy is up to $70 billion. Everyone knows about WCM. Performance has been great. But typically when you see that early stage manager, if you can get in before everyone else does, you typically have a little bit more alpha than you would get when you jump in when everyone else is in the strategy. So that's one example. The other way you could look at that quote is think about maybe high quality managers that have been underperforming. And what we tend to see with a lot of clients is the behavioral aspect. So they'll fire the manager that's underperformed and they'll hire the manager that's outperformed. If you have a manager that's of good quality, you like the team and the process, they've underperformed for a couple of years, that's a good time to get into that strategy. And so that's the other way I kind of look at that quote.
Yeah, thanks, Rob. And I'm just thinking a bit about, we've worked together a lot over the past month, building Orellan's global shares strategy, and something I was quite interested in when we were working together on that was firstly, I'd never heard of a lot of the managers that we've ended up ultimately going with, and I thought I knew most managers because I've kind of travelled extensively and looked at managers around the world. And I suppose just to touch on one in your Wilshire International Shares Fund, which will feature in our fund as well, is Los Angeles Capital. Again, a manager I hadn't heard of, probably not a large manager in a global scale. But, talk us through how you identified that team, you've supported them, and you've had a really good experience, right?
Correct. So they are a systematic quantitative manager, and I've been following them for a dozen years. So the interesting thing about LA Capital is they used to be part of Wilshire. So this was kind of the investment management arm within Wilshire. They kind of bought themselves out in the early 2000s, started their own shop. And I was at a different shop at the time and was following them at the time. They were just very different than other quantitative managers. So they actually base their process around investor preferences. So they don't have systematic biases towards value, towards growth. They're basically going to where the market is pricing risk and what investors are looking towards. So they were very different than many other quant managers. And when you look at their performance, they have a different profile. And over time, they've performed very well. They've slowly grown their assets. They've grown their infrastructure. And I've just been really impressed with the quality of the people that they've hired in their unique process.
Yeah, cool. And just on your manager research process, Rob, I know it covers kind of a range of factors, and I suppose going through them as someone who's run these processes myself before, I did see a few things that were quite different and perhaps in my mind not so intuitive. And one of them was around attribution. So attribution is obviously part of your ratings model. And I get it now, but if you can kind of go through the thinking behind including that and perhaps the behaviours that looking at attribution perhaps reinforces.
Yeah, so when we look at attribution, it's not just does the manager have an attribution system where they're reviewing their performance and seeing where that performance is coming from, but that there's a feedback loop. So we all know that this industry is very difficult, and if you're not constantly trying to get better, you're falling behind. And so what we want to see is managers looking at that attribution, maybe identifying certain areas of weakness that they can improve in their process. For example, maybe a manager has had good performance overall, but within financials, they've had tough stock selection. Maybe they need to go back into their process and take a look at what's going on in that sector. Could it be the analyst that's covering that sector? Could it be certain factors that don't really apply well in financials as they do in other sectors? So finding a way where they can look at that attribution, understanding where there may be some weak points in their process, going back and then making enhancements to their process to improve their performance over time.
Yeah. And another aspect of your rating framework is perhaps a more traditional one in organisational structure and alignment. I'm just going to spin the question a little bit just to talk a bit about, in our global equities fund, I noticed on our shortlist that many of the managers were employee-owned firms. Is that typically what you favour when looking at what's the best-in-class alignment structure for managers?
We do. All things being equal, we do like that employee ownership, that alignment of interest. In addition to the ownership, also eating your own cooking, so to speak, so having your own money invested in the strategy. Those are all things that we look at and would give a more favorable rating to that category.
And look, back to attribution, Rob, and you're probably going to sense that as I ask this question, it might be a little bit of a loaded question, but what sort of managers are the most consistent? You rate these all the time. You've got a large team looking at managers. Is it the managers who focus more on stock selection, Or are there actually global equity managers out there that have persistently been able to add value by picking sectors and picking countries to add alpha over time?
No, for us, it's been the managers that are focused on stock selection. I think it's just incredibly difficult to consistently add value through top-down calls, whether it be sectors or countries. So most of our focus is on managers that kind of do it through bottom-up stock selection. And having that consistency there, it is important to look at the macro, look at the top-down, and have that inform your decisions. But we just have not seen that manager that consistently make those calls. And so our preference has been to go with those bottom-up stock selectors. And then within that, to control that risk outside of that. So when we look at, kind of portfolio construction, if you are that bottom-up stock selector, that's where we want to see that risk coming from. If you're having all these sector bets or country bets, that could be really swinging your performance. So our preference would be to kind of neutralize that or minimize those risks and have more risk be idiosyncratic or stock selection in your portfolio.
Yeah, cool. And I suppose that goes back to the whole attribution feedback loop sort of thing that you were talking about earlier. Rob, we've talked a little bit about the global equity fund that Wilshire and Orellen have built together, but perhaps bring it a bit to life for us. We have our first meeting. We talk about the fund that we're trying to build. Obviously, it's not from scratch, given you cover a lot of global strategies. You've got the Wilshire International Shares Fund that's done very well for a very, very long time. But, talk me through the process of, I suppose, working with us and getting to the landing point that we've got to around picking the managers and perhaps the style balance kind of within the portfolio.
Yep. So we always start with, who are the managers we like in the global equity space? And then getting understanding from the clients, how many managers do they want to put in this portfolio? So with this fund, we're starting with 3 managers. So that kind of in the back of our mind leads us to believe, okay, how can we find 3 managers that are strong, high conviction, add value, but are not correlated with each other? Ideally, when you build a multi-manager portfolio, you want to be able to retain that alpha, but reduce your tracking error. And the way you do that is find managers that do add alpha over time, but they do it in a different performance pattern. And so what we've done with this portfolio is we've added, kind of 3 managers, and they're all a little bit different. We have 2 style-oriented managers. On the growth side, we've got Loomis Sales. On the value side, we have Causeway Capital. And then we had talked about LA Capital as the core manager. And so if you think about the 2 wings, so the value manager and the growth manager, they're typically going to have a different performance pattern. So usually when that growth manager is in favor, the value manager may be underperforming a bit, and vice versa. And then you want the core manager, LA Capital, in this instance, to be a little bit more style neutral, and to also be a little bit more all-weather and lower tracking error. So with that manager, you can kind of control the overall risk of the portfolio and bring some more stabilization to that performance pattern. And then you have the 2 kind of value and growth managers, the wings, kind of pairing off each other. So when you have kind of more of a growth environment, think of when AI is in favor, a lot of these growth names are in favor. Loomis should perform really well. Maybe Causeway underperforms a little bit. But if you have more of a cyclical kind of value rally, that's when Causeway is going to do really well. So again, the key is to find high conviction managers that when you bring them together in a portfolio are going to reduce that overall tracking error and are going to give you a nice, smoother performance pattern when paired together.
Yeah, cool. Thanks, Robin. Something in every manager research framework is, I suppose, a tipping point or a breaking point, or to use a sporting analogy, yellow cards and red cards. Talk me through, Rob, what are some of the reasons that you might lose conviction in a manager?
The easy one to start off with would be any changes to the people. So if you have a portfolio manager change, if you have something significant happen at the firm, so leadership changes, maybe they get bought out, so there's some type of organizational change. That's really the easy one to kind of pick out. The other ones are a little bit more challenging. We always look at performance and want to be mindful of when is that performance deviating from our expectations. So I mentioned, the growth manager in Loomis. We would expect them to do well in growth-driven markets. We would expect them to underperform in value markets. If we see any deviation from that, that's when we start asking questions and think, okay, have they modified their process? Are they doing something different? So looking to detect, performance patterns that are different than our expectations. Those are things that will take a little bit more time. Obviously, the people change would be, pretty quick. You can detect that. But again, it's kind of, are they doing something different than they communicated to us? And are they doing something different than how we would think they would add value? So changing process would be a big thing for us.
Yeah, and something I've been quite impressed with, Rob, is how much of a mix your process is, just with regards to, I think a lot of people think about manager research as being, really qualitative. You sit down with someone, you look into their whites of their eyes and you go, is this person going to add value? But actually working with you guys, I've noticed the element of quant that comes into it as well. Like, sure, you go and meet the managers and perhaps don't stare them too closely in the eyes, but you definitely go there and do your due diligence and have your follow-up meetings. But you've also got that quantitative side. So just talk me through a bit of some of the tools that you use to do that and kind of how they've developed throughout the years. Because when we partnered with you guys, I was quite interested to find out that you founded in, I think, 1972. And in your early years, you're actually more known as a financial technology firm. But working with you, I can see that those roots still run really deep.
Yeah, so to your point, Wilshire was founded by Dennis Tito, who was an actual rocket scientist. So he worked with NASA and the Jet Propulsion Lab, a really smart guy, and he wanted to bring quantitative tools to the analysis of investments. So that DNA has always been within Wilshire. We've had some internal products that we've utilized in terms of looking at different sources of risks, of multi-factor models. We do a lot of traditional Brinson attribution. So where is that value being added from? Is it stock selection? Is it country or sector rotation? And it's important to us, I think, to marry the quant with the qualitative. It's very easy, especially for a young person on our team, to be impressed with a lot of the portfolio managers that we talk with and get wowed by how they present to us. And so it's very easy to say, oh, this is a really smart person. I'm going to rate this strategy highly. But then when you look at the numbers, you see something different there. And, people can be impressive presenters, but when it comes down to the performance, it's not coming through. And so you need to have both sides. You need to understand the people and the process, and you need to marry that with the performance and what you see from that. And if there's a challenge there, if we cannot understand, and I'll give you an example of this. Oftentimes we'll meet with very impressive people and we can see that value is being added, that the strategy is beating the benchmark. But when we look at the attribution, it doesn't make sense to us. They tell us they're a bottom-up stock selector and all their value is being added through sector rotation or through country overweights. We actually won't rate that manager as highly because to us, they may be getting lucky. We don't think this strategy or this process is repeatable. We need to understand how you're going to add value, and that needs to play through the numbers. So if we can't make that connection, we'll typically pass on that manager.
Yeah, cool. And that's I feel a lot better now because, as part of our partnership, we have access to some of your tools. And, once we get to the outputs are amazing. But I I feel better that it was put together by a rocket scientist now, because it took me a while to kind of, learn how to use them and get the outputs in a way that I wanted it. So no, thanks for that, Rob. I feel a lot better about myself now. All right, Rob. So now we're going to move to the part of the podcast, which is really the fun part of the podcast, where we learn a little bit more about you. So what's something that you've bought recently that you think's quite cool and perhaps reflects a bit of your personality and what you like to do?
So I would say I haven't bought a lot of things. My purchases have been more experiences. And so one thing about me is I love live music. And so my most recent purchase, we went to go see Mumford & Sons. And my wife and I love live music. Mumford & Sons, the band came through Chicago a couple weeks ago. Went to go see that show. And so that was kind of my most recent purchase. We've always loved going to live music. I've loved music since I was a kid. I grew up in kind of a small working class town and was a little bit of a metalhead, hard rock fan. So you think of, your AC/DCs, your Metallicas, Van Halens. That was kind of my thing growing up. And so it's a little bit different than kind of the buttoned up manager researcher, but I do like classic rock.
Awesome. Oh, you're full of surprises, Rob. So I'm looking forward to unwrapping more of them as we get to know each other a bit more. Also, some quick fire questions we've got for you here. So what's a book you'll recommend?
The most recent book I would recommend would be a book called Outlive. It's by a medical doctor, Peter Attia, and it's essentially about longevity and how each of us can live a more healthier lifestyle, how we can avoid diseases, and it's a bit in depth. He is a MD, and so he goes into kind of detail about cancer and about heart disease. But it was really a great overall book to understand what we can control in terms of our lifestyle and habits, to not only extend our life, but extend the healthy part of our life. So it's not just living to 90, but living healthy to 90 and not having the last 10 years of your life be, tied up to tubes in a hospital bed. So it was a really kind of enlightening book to see what we can control ourselves, as opposed to what just modern medicine can do to keep us alive.
I like that, Rob, and you've really played into the theme of the podcast being intergenerational thinking from a different angle there. So thank you for that. Tell me a lesson that you've learnt the hard way.
I would say in this industry, it's hard to be a people pleaser. I can be a people pleaser from time to time, and you spread yourself a little bit too thin. So early on in the days when I became an investment researcher, I'd want to meet with everybody. When you do that, everyone is wanting your time. So once you become friends with managers and then everyone wants your time and invites you to this or that, and learning how to say no was a little bit difficult for me. But it's an important word to say when your time is more precious. And so I think understanding when to say no in this industry is important.
Cool. And what's something, we've learned a bit about you already on this podcast, particularly the hidden heavy metal side of you. But what's something else that is a bit different about you that people might not know when they see you across the table as a manager researcher?
I think my path is a lot different than many people in this industry. Grew up in a small working class town. My mom was a teacher. My dad worked for farm service. None of my family members are in the industry. And so it was kind of the journey of me finding my way into investments, just reading some books as a kid and understanding that, whoa, there's a way you can make money without actually working. You can have your money work for you. And things just kind of generated some interest there. Went to a small state school and kind of found my way into this industry in kind of an unorthodox way. But I think that's also helped me have a little different perspective than, the people that maybe grew up in a different socioeconomic background or went to a fancy school.
Yeah, cool. No, Rob, I mean, that is an interesting part. I mean, it's even interesting for me that you dial in to us today from Chicago, Illinois, because a lot of the time when you think of investments, you think of Wall Street, you think of New York City, and you don't think of the Windy City. So why is it called the Windy City? This is a little sidebar.
So it is windy here, so we do often get a lot of winds, but the real reason is because of the politics. And so they would call it the Windy City because the politicians have been, they talk a lot, not a lot gets done. And so we've had some interesting characters over the years in Chicago politics. There was a joke that sometimes you would go from mayor to then jail or governor to jail because there was a lot of corruption. So the windy part is more around kind of the corruption and less about the weather.
I can't wait to get you over to Wellington and you'll see what a windy city is just as you come in to approach your landing if you get it the first time. Coffee, tea, or something stronger for you?
It's funny. I'm a tea person. I've never drank coffee. My wife doesn't understand how I can go throughout the day without drinking coffee, but I do like tea.
Nice. Hey, thanks so much, Rob, for your time today. I've learnt so much. I came into the call thinking, here's Rob, this straight-laced head of manager research for Wilshire, and I've come out of it knowing a little bit more about your history, and I'm just trying to see whether there is a AC/DC shirt kind of just below your work shirt there. But hey, it's been great to talk to you. I've really enjoyed working with you so far, and really looking forward to continuing this relationship and seeing all the work we've done together on the Orellen Global Shares Fund actually come into action when the fund launches in a few weeks' time. So thanks a lot, Rob.
Thank you, Chris. It was good to be on.
And that's all we have for you today on the Orellen podcast. Thanks so much for listening. If you want to hear more from Orellen or get our research, look us up on orellen.com or subscribe to us on LinkedIn. See you next time. Thanks for listening to the Orellen podcast. Everything we've shared is general information only, not financial advice. If you'd like guidance in your own situation, please talk to a licensed financial advisor.